Welcome all to the Node. I am Mike, aka Veteran Crypto, and this is your place for news, interviews, and DeFi, crypto, and TradFi education. So, David will be joining me here in a minute, but I want to point out that David called it. He's been saying that there's been a bear flag on the charts for Bitcoin for a bit now, and it looks like we've broken down. I mean, I'm personally up about 26% on my short since I opened it, and I opened it actually a little while after he was talking about the bear flag. So I'm doing okay. It's just a 2x, $100 2x. I've made like 25, 26 bucks. Nothing major, but he called it. So, hey, what's up, Food is Life? How you doing, brother? So yeah, let's go ahead and get in the socials, get those out of the way so we can just get to the news. So let's see. Let's actually add David here really quick before I pop over to here, and I'll add him again.
Hello, buddy.
Hello, buddy. How
Hello,
you
buddy.
doing?
I'm doing good.
I'm not your buddy, pal.
I'm not your pal, guy.
I'm not your guy, friend.
So what comes after that?
I don't know. I don't know. I like that one where the guy's yelling across the water, and he's like telling the guy to like screw off or whatever, and he's like, you know what I was doing last night? He's like, don't do it, don't do it. He's like, don't bring my mother into this. Basically, I was just saying that you called that bear flag. You know, Bitcoin is broken down. I'm up about 26% on my little 2x short. Looks like who was it? Crispy in the chat is saying he's up on printing on his shorts this morning. So the community, is looking good right now. So
I love it, man. I love to hear it. Happy that people took action and are making some money. I'm making money too. So I'm very, very happy. Today's a good day, and all I'm thinking about now is hedging my shorts, because I don't think that this move is done. I think we probably got 2 more weeks. Like, I think by the end of this month, some type of important low could maybe. Look, I don't have a crystal ball, but I also spend basically all day, every day staring at charts, and I have for years. So there are patterns that repeat. You kind of get a feel for how things move. And I'm thinking to myself, I'm looking over here at Bitcoin. It's basically a couple hundred points off the lows today. And I'm just thinking that, there's going to be a bounce. But when that bounce comes, I want to sell that bounce. So whatever the dead cat bounce is that comes, that's when I want to add to my shorts. Because I think that Bitcoin, the moment that the S&P and the NASDAQ decide that they want to correct, dude, even just 5%, the S&P and the NASDAQ have been straight up. And the moment that they decide to correct by just a couple of percentage points, then I think we'll get the
risk on. Anything risk on is going to take a massive dump. It's just going to spook the whole market.
Yeah, so things are good. Things are good. Although the only thing that's not good is I was trying to just buy hype on a breakout above 74, 75 last night. I tried once, I tried twice, I tried 3 times, and each time it was like fat. I just kept getting smacked, man. And so I gave it up. I was like, okay, no more hype. And now it's pulling back a little bit at 72. But of all of the plays on the board, I think that hype is the only one that I could buy, right now, anyway. So
I just cannot. I know we've talked about this, and I'm probably going to miss out, but I cannot buy with these epic pumps it's been on. I have to wait for a pullback.
I know. I hear you, but it's literally the only project that makes money, any decent amount
not
of money.
The only, but it's
but really, if we're talking about decent amounts of money, it's basically the only one.
Well, the one that makes money and has good tokenomics to where the revenue generated by the protocol actually makes its way back to token holders. It has the whole package. It's one of the very few that have the whole package. Absolutely.
Yeah. So, if I was going to buy anything, I would buy hype and I would buy it with the expectation that it could, be down 50 or 60% over the next, couple of months. Like
Yeah.
that would be my expectation. But
And that's when I'll be buying it.
but but I want to buy it because I think that it has an actual shot at going to, the 70, 80, 90, 100 billion market cap type range. And that's like 300 or $400 hype. I think that
And
it could actually do that because it's actually that useful. The protocol is actually that good and it actually makes money. Like,
yeah.
you compare it to like other protocols that make money, it's basically number one outside of Tether and Circle. USDT and USDC, those products, they're number one and number two. So Tether's number one, Circle's
Oh,
number two.
and
But then hype,
Camp's
well,
making like 2 or 3 million a day.
well, yeah, but the tokenomics aren't quite there yet.
Hmm.
Not quite there
Valid,
yet.
valid,
Yeah.
very valid.
So, but I mean, yeah, it's tough to buy anything right now. I mean, even like the Mag 7 stuff, like, by everyone that I watch, Mike, all the guys who I've been watching for years, these are traders who have been in markets like for 20, 30, 40, 50 years in one case. All of these guys are saying like these stretched valuations, or at least there's a lot of metrics that make them think that the market is very expensive. Talking about the S&P and the Nasdaq,
Mm.
um, and yet you've still got guys like Tom Lee going out there saying that there's likely going to be some type of correction, but then after that, we're probably going to see the best 24 months on record in our lives, like in like our lifetimes. The last 60 years of markets. So, and I can see that because the robotics, man, AI plus robotics, like that is a revolution that like all that sci-fi shit, all the sci-fi movies that we see, like AI plus robotics, that, means that all that sci-fi shit becomes reality, So I think that at a
The
certain point,
talk about the dystopian future.
I don't think it has to be dystopian. I think that it probably will be in a lot of places. Just because if there's going to be people in control, or if people have programmed the robots to think a certain way, then yeah, that's probably not going to lead to positive outcomes. But when I think about like markets, though, and these different equities or digital assets that you can buy and potentially make money in US dollar terms or in Bitcoin terms, I really do think that even if there is some type of a correction, you've got to buy it. You've got to buy it like hand over fist. Like if equities ever correct, like you got to step in and buy it because I mean these companies, man, like Google, Amazon, Apple, Microsoft, Tesla specifically Tesla because they've got a visionary at the helm in Elon Musk. And then you've got what's the last one? Nvidia. Like these companies here, man, like
Oh, did,
markets
did,
don't.
did you see? Did you see that news that there's that freaking massive data center that's going to be built in Utah that's like 3 times the size of Manhattan?
Yeah, yeah, yeah. But so what? You know, great.
No, no,
Build
no.
data
I mean,
centers.
I'm just saying that
Yeah, I
that's
think it's great. I think
I mean, that's
build
going
all
to
the data
be
centers, build the
that's going to be
power.
huge for Nvidia. That's going to be huge for AI. That's going to be huge for a lot of this tech.
It's going to be huge for America, like being built here.
America,
America,
America.
and they need to build power. Like that's the thing. They need power. Um,
That honestly, that is the choke point right now.
yeah,
Is a lot of people talk about these data centers and all this stuff, and really, it's our freaking infrastructure sucks.
this
The
old.
power grid. The power grid is just outdated, patchworked. They need to put a lot of work into upgrading the power grid.
Yeah, yeah. Everywhere that I go around here, in the United States, everywhere that I've been, it's like it's a giant shopping mall, like everywhere. It's just like there's the same 10 stores everywhere. It
Yeah.
all looks identical and it's all like decaying. Like the infrastructure is decaying in many, I would say most places.
Yeah.
And like that needs to be
Oh,
addressed.
roads, bridges,
Yeah.
power grid, water, it just all of it. I mean,
I
hell, you
mean,
had freaking in Flint, Michigan, and a lot of other places. they were still using lead pipes, forever. And then you have, the power grid in Texas. They had an
Well,
ice,
a little lead never hurt anyone,
right?
especially in the water. It's good
Yeah,
for the
yeah.
children.
It dilutes it, so it's not as bad.
Yeah.
But and then like Texas, there was an ice storm, and they were about 30 minutes from basically their whole grid just burning out. I have a bunch of family down there. It's just bridges, over on the East Coast. I mean, hell, like there was freaking a couple of major bridges that just collapsed with cars on them and shit. You have railroad tracks, freaking trains derailing because the freaking rails, freaking snake, and they bent and S shaped and stuff like that. I mean, it's we need to freaking invest in our infrastructure. So
I say, take all of the Medicare money that's going to California, just California, and use that to build the
hell,
infrastructure. It's like
just
$200 billion a
dude,
year to pay for healthcare for
just cut
illegal
all the
migrants, dude,
fraud. Just
illegal
cut all the
invaders.
fraud in the government with our tax
Oh
dollars.
my
We could,
God, just
well,
cut
well,
it all.
let's save it for Thursday. All right. So we're gonna do something a
Oh
little
my
bit different.
God, Dad. Chinese cities are not the future of technology. You see, my dad sees this content on the internet,
Yeah,
and these Chinese cities, like, so that's why, Dad, I was telling you to go on X, because
they're tofu cities.
it's fake. It's completely
Yeah,
fake. And like these
fugazi,
accounts, it's
fugazi. Hey,
completely
hey.
fake, dude. Like many of these buildings are just a shell. Okay.
Yeah.
Even in like the tier one cities. And then when you look on the ground, because you can see video content coming out of mainland China. And when you look on the ground, what you'll see is it's the gleaming skyline. And then people make $10,000 a year. Like China is not this up and coming, like, power to challenge America. China is like
Your
literally,
dad, your dad's all be respectful, David.
I'm doing my best. I'm doing my best. But like the problem is that when you see content on the internet, like specifically around the Chinese, because they pay influencers to put out, content that makes them look really good. But you can, if you want to, you
Oh,
can
dude,
go and see what's going
countries
on the
like China
ground,
and stuff like that are
and
great at
it's fake.
propaganda. North
It's
Korea,
yeah.
same thing. North Korea, the city, like the main city, Pyongyang, is very, very polished for being North Korea. But you go outside the city and it's grass huts. I mean, it's basically poverty. People are
What
starving.
I'm saying is that even in the cities in China, even in the tier one cities in mainland
Oh
China,
yeah, yeah.
that
Well,
it's
well,
yeah.
we're gonna do something a little bit different
Well, we're
today.
going to be talking about China because we're going to be talking about Aster
Oh
and
yeah,
BNB.
absolutely. So, but
Yeah,
we're going to do something a little bit different. We're going to actually move the doing the socials to the end.
awesome.
So I don't want to spend 30 minutes at the beginning of the show every day going through socials. I want to get right into the news, get right into the deep dives, and then when everybody's here and they've enjoyed the content, we'll show them where to find us, where to follow us, and
Sweet.
they can help support the show. So that being said, we're going to go straight into the news. So Bitcoin slump, if you haven't noticed. Bitcoin has dropped below 69K, marking a 2-month low. So it's at 67.8 right now. The decline is being attributed to a combination of materially softer demand, the institutional outflows from the ETFs that we've been covering for the past couple of weeks now, pretty much straight, and the broader macroeconomic anxiety. When you got oil pumping, you got Iran, the war over there, doesn't seem to be cooling off. So, I mean, what are you seeing as far as Bitcoin? I know that we've talked about it quite a bit. You've detailed the bear flag that was printing, and we broke down. So,
Yeah. So here, let me just maybe share my screen real quick, and we can take a look through and talk about Bitcoin. Maybe talk about some altcoins just real quick. But yeah, so it's really simple. What I see here on Bitcoin, and that is just a bear flag that has confirmed. So here's the pole, here's the flag, and it has broken down below a level of support. This is on the weekly. So when you zoom out, whenever you're in doubt about some piece of analysis on a chart, just zoom out on the chart. If you're looking at it at a 5-minute, zoom out to an hourly. If you're looking at it in an hourly, zoom out to a 4-hour or a daily. If you're looking at the daily, zoom out to the weekly. And then if you want even more confirmation, zoom out to a monthly. Sometimes that's valuable. If we take a look here at BTC on the monthly, this to me looks like we're just starting to break down, and 60K is the level of support to watch on the downside. When that breaks, and I think it's not an if, I think it's a when that breaks, well, then we zoom back into the weekly, we throw down this 200 period moving average, and then we can see, okay, well, if or when this gets tested, it likely breaks. And if it breaks, there's no support until you get down here to 49. So that's the thing. Like Bitcoin, if it looks like it's starting to enter free fall, kind of like it did here, going from, where was it, like 98K to 60K. So basically 100 to 60. It's a 40% decline in 4 weeks. So, we're from 82 to, 68. So we're down, what is that, like 25%, something like that, just in the last couple of weeks here. That's the last 4 weeks. Let me just measure that real quick to see what that has been. So it's only 17%. So if we're only down 17% from 82K, well, there's still plenty of room to go. Plenty of room to go, even from the current prices. I mean, I think Bitcoin probably sees another 28% on the downside, maybe a little bit more than that. The reason why I don't think that, a lot of people have been talking about this level down here, this like $33,000 level. I don't think that that's likely, because when Bitcoin was up here at 126, this level up here, you've got to think about expected move. And so the expected move up here at 126, it was like, at 40% vol. So we could actually run that real quick over in Gemini, and we could figure out what was the expected move then. If I own an asset with a volatility of, let's give it 45%, and a price of $126,000, what is the expected move over the next 6 and 12 months in percentage terms and in US dollar terms? Okay, so let's see what it comes up with, because I think that this is probably going to give us a pretty good idea of, maybe, depending on what the number prints, that maybe we could figure out like where the bottom could come in. Because, Bitcoin's volatility compressed on the way up as a result of those Bitcoin ETF products launching. So, those ETFs took Bitcoin's vol from 70% to like 40, 45-ish percent. So when volatility compresses, so does the expected move. So the expected move is, how much you should expect an asset to move over a given period of time.
Yeah,
So
no, it's, whenever you get less volume, that's why on the weekends, a lot of times that we see these massive moves is with less volume, it's a lot easier to move price.
So check it out. It says that, and this is the one standard deviation move. So there's a 68% chance, that's a one standard deviation move, that Bitcoin will be between 69K and 182K in 12 months. And that's measuring from the all-time high. Now, I want more than one standard deviation. I want, something like 2 and 3 standard deviation moves. So give me 1 sigma, 2 sigma, and 3 sigma expected moves. So sigma is just like a shorthand for standard deviation. So 1 sigma is the 68% move, 2 sigma is the 95% move, and 3 sigma is the 99.7% move. So very unlikely, statistically speaking, to see a 3 sigma move, but Bitcoin does shit like this. These are tail risk events. They call them black swans. So over 6 months, the 1 sigma move, 85K to 166K. The 2 sigma move over 6 months is from 45K to 206K. The 3 sigma would be $5,000. So that's over 6 months. Okay. So very, very unlikely. But you could see Bitcoin down here at 45, a 2 sigma move, that's plus or minus 63%. So that US dollar move from the highs would be minus $80,000. That would bring Bitcoin to 45K. That would make sense to me, because that would actually be the most shallow drawdown in a Bitcoin bear market, I think, ever. A 63% drawdown from the highs. So if we just measure that, from the all-time highs, we measure a 63% drawdown, then yeah, I mean, we're talking about just like a little dip below this level of support. So you see this level of support here, that horizontal that I've drawn in, that's at 49K. Just a little dip below that to 45K is what the 2 sigma move would be over 6 months. So I think that makes sense. Actually, that makes a lot of sense to me, and that we see a shallow drawdown, and a 63% drawdown is not shallow, but in Bitcoin's history, it kind of is. But then you got to start to think about, okay, what about ETH? ETH is a more volatile asset than Bitcoin is, and but ETH actually has like a real use case. Bitcoin is still, if we're being completely honest, people need to either build layer twos on top of Bitcoin's layer one, or they need to build directly on the layer one, and there needs to be covenants to be able to do that.
Well, there
Um,
needs to be some native DeFi as well.
Right, that's what I'm getting at. Yeah,
Yeah.
there needs to be native DeFi, and without native DeFi on Bitcoin, it is not digital gold. As much as people want to say it is,
No,
it's not.
no,
You
it's not.
know, and those miners are not going to keep their machines on if they're not incentivized to. So, Bitcoin miners need transaction volume. And, two more halving cycles go by and the miner rewards get cut in half and in half again. And then suddenly they're going to be getting like zero point 0.7 Bitcoin for solving a block. And that's just not going to cut it. They need transaction volume. Otherwise, why would you be incentivized to keep your machine on? And I see one of the guys is talking in the chat about Ondo. Again, tokenomics. And, until,
And really quick, I want to stress something. With all the trash that I talk on X and stuff like that about XLM, about Ondo, about XRP, all of these, all these tokens that have terrible tokenomics. It's not to say you can't make money off of them. I mean, you can short term trade them. You can even hold them for a while. I mean, don't underestimate people's ignorance on the actual value capture on these tokens and the retail hype buying. I mean, you can make money off them. Do not get me wrong. However, long term hold and actual utility of these tokens, you cannot ignore it. Do not FOMO a large majority of your portfolio into these, because when people start to actually get educated on these tokens and their tokenomics and their connection or lack of connection to the underlying protocol or chain and the profitability, the value capture, these tokens could take a massive dump and never recover. So be very, very careful. That is all we're trying to do here, is educate you, not influence you. You are free to buy whatever you want. If you want your entire portfolio to be tokens with no value capture, it's your money. Do what you want. I will sleep like a baby at night. It doesn't bother me in the slightest. We are here to educate you. What you do with that education is 100% up to you. I have no emotional attachment to you either buying or selling a token. I don't care if you buy what I hold. It we genuinely just want you to be educated. What you do with that is up to you. But that being said,
yeah, no, I agree with you. I think that most of crypto is dog shit. Uh,
yeah,
so, like, honestly, like most of it
let's
is just
we gotta
garbage.
be honest. Yeah,
Yeah, like, because even though there's a lot of protocols out there that are super cool, like they do cool stuff, they're a lot of fun to use. You can, maybe like make some money by, using these protocols. Um, if you use the protocol, that's great. But if that token, maybe there's a protocol token or a governance token or some type of other token associated with that protocol, if you use it and there's no way that the revenues that the protocol generates actually accrue to the token, then
AKA value capture.
yeah, there's got to be value capture. Like if there's not, then you're just kind of holding, Mike, you like to call it a trading card. I call it a meme,
Yeah.
whatever it is, like it's a fugazi. It's not real, like you need real value capture and the protocol needs to actually do this thing called making money.
Yeah.
Like it needs to make
Yeah,
money.
it
Okay.
doesn't matter if it shares the revenue, with token holders if it doesn't make any. It's like,
Right. Like I was talking to an old client of mine last night. He likes to always send me this stupid bullshit about XRP and XLM and
yeah,
Quant and all these garbage projects. And,
the
you know,
ISO
oh my
20022.
God, man, it's so frustrating because, he can, for as long as I've known him, he's suffered from this same cognitive dissonance where he
Yeah.
believes that a partnership, like, oh my God, look, XLM partnered with DTCC. Like, okay, number one, you got to find out what that actually means. And
Yeah.
number two, it means nothing for XLM for the token.
No,
Like nothing at all.
it is a super cheap, and in our library,
It's like a
I'll show you.
gimmick. It's like a way to, yeah,
I'll
yeah.
show you at the end of the show. I actually did. Me and David and Jeff have been going to town, generating the little videos that we do for the short, for the deep dives and the slide presentations and all that, and putting them in that library that he built on the website. I did 3 yesterday. I did another one this morning, and I'll probably do like 2 or 3 more later today. But it's, if you don't believe us, I mean, watch the material and by all means fact check it. Let us know if we get something wrong. I'll redo the material if if there's something that's inaccurate in it. We are not afraid to admit that we're wrong about something, but we are going to educate off the facts that we are able to find. It's what, again, what you do with that is up to you. But yeah, XLM is the same as XRP. I mean, XLM was made by what's his name, uh, Jensen Johnson, something like that. Basically, he was part of XRP. He was part of Ripple, and he left Ripple and started Stellar. And it's basically the same thing. Like the price of the gas token, 0.00001, XRP, or 0.00001 XLM per transaction. Exactly the freaking same. There's almost no difference between them. The tokenomics are exactly the same. Almost. I mean, pretty damn close. But it would take at max TPS, it's like 4,000 TPS if memory serves. It would take over 5,000 years to burn. Like it was like 560 or 5,600 something, to burn just 10% of the token supply. So in your lifetime, in your kids, in your grandkids' lifetime, not enough will be burned in fees to make it deflationary enough to make price go up. The only thing making the price go up right now is people that don't understand the tokenomics and value capture aspect, FOMOing into it and buying it.
Yeah, it's a real shame because every time I hear someone, talking in a positive way about XRP or XLM or Quant, or you can kind of group them all together because, I think that they all have the same type of really gross people on social that shill them.
Yeah.
But whenever you see someone shilling that garbage, it's almost always in the same breath as, oh, Goldman Sachs or DTCC or Bank of America or whatever, you name big financial institution
You know what?
partnered with or
I'll do, yeah.
doing stuff with. And it's like, dude, like number one, in my opinion, I don't think that's a good thing. Like,
No.
okay, just right
Well,
off the bat. Like,
but
I,
check this out. So I'll
yeah.
do XRP later, but this is our website. I'll show you later. But up here in the menu bar, Intel Library. So this is where we've been posting these. You can see yesterday we did stable coins and the different types of stable coins. A deep dive into that, and we did hyperliquid. Today we're doing liquidity BNB and ASTER. But you can see yesterday I did Tron, Ondo, and Canton, and then this morning I did Stellar. So I'll do XRP later. But we also got Athena's, USTB, we got Advantis, we got Plasma, and we're just going to keep filling this up with all the different tokens, good and bad. So
And I got to say too, I'm working on getting the the formatting of this to look good. It's turning out
did we lose David, or did we lose me?
No, I'm here. I'm here.
Oh, there you go.
Yeah. So I'm working on getting the formatting of those reports to become beautiful. It's not quite there yet. It's getting closer. I shipped an update earlier this morning, but I'm trying to get the written reports to look really, really good, and then we're going to standardize the way that is generated so that all the reports look the same. So you know what to expect. And yeah, so that's really coming along and looking great, I think.
You need to make a note to make my account an admin account or something, so that I don't run into, like, whenever I try to go into this to show people that my free preview is into.
Like, oh yeah. My bad. I can do that today. Let me take a note to do that. I'll make sure that your email address and Jeff's are put in there. Okay.
So next up in the news, we got macro pressure, hotter than expected U.S. inflation data, and failed peace negotiations between the U.S. and Iran impacting energy and oil prices are driving a general risk-off environment, hitting both crypto and related equities like Coinbase, ticker Coin, and Mara Holdings. Institutional DeFi milestone. BitGo Bank and Trust and Concrete Network Services have announced a partnership to launch an institutional on-chain asset growth platform. This is a significant step in allowing institutions to earn yield on assets while maintaining qualified custody. I have never heard of either. I've heard of BitGo, but I didn't know they had a bank. Let's take a look at this. So it says, this collaboration is designed to enable institutional clients to earn on-chain optimized asset growth while their underlying digital assets remain in qualified custody through BitGo Bank and Trust as a federally chartered non-depository trust bank subject to OCC oversight. BitGo Bank and Trust meets the enhanced capital audit and compliance standards, proving the regulatory foundation underpinning the platform. Concrete and BitGo aim to address a critical need for institutional investors who have traditionally faced a trade-off between security of qualified custody and access to the growth opportunities in decentralized finance. By integrating Concrete's advanced vault architecture with BitGo Banks and Trust custodial infrastructure, the platform intends to allow clients to select the access-vetted, transparent, and productive strategies offered and operated by Concrete. Let me see if I can scan through this. And so this sounds a lot like what Coinbase is already really doing when it comes to institutional money and custodial, for the ETFs, Morpho and all of that sort of stuff. So I mean, definitely this is bullish. It just shows growth, and that this the integration of TradFi and institutional adoption into the crypto rails, this hybrid DeFi TradFi merge is moving forward regardless of what the market does price wise. So what are your thoughts on this, David?
I'm going to be honest with you, Mike. I was working. I wasn't even listening.
All right.
Sorry.
No, not a problem. Not a problem. I'll just keep.
I'm working on getting the formatting of the reports in the Intel library, the Intel bundles. What I'm working on here is I'm making sure that the AI formatting of the written content looks good, because right now it's just kind of meh. Like, it's not all that readable, and I want to be able to read this stuff. So yeah, that's what I was working on as you were talking. My bad, man.
No, you're fine. I do that all the time. While the deep dives are going, I'm like on social media trying to let people know that we're doing a deep
I could have bullshitted you. I could have been like, oh yeah, yeah, it's great.
integrity. You use the integrity. I like it.
Yeah.
All right. So, Galaxy expansion. Galaxy has launched an institutional over-the-counter prediction markets trading desk, executing a $10 million trade at launch to help hedge funds and family offices hedge against event-driven risks. So let me take a look at this. The offering covers, excuse me, the offering covers instruments referencing non-sports event contracts traded on Kalshi and Polymarket, spanning economic, political, geopolitical, and other event-driven markets, with plans to expand to additional platforms. Galaxy can also pair prediction market positions with hedges in equities, commodities, and other assets, giving clients the ability to build complete risk strategies around a single event rather than managing exposure in silos. Galaxy has already put the offering to work, executing a $10 million trade with Arca, a crypto native hedge fund, on the outcomes associated with the passage of the Clarity Act. Galaxy's OTC or over the counter desk facilitated Arca's trade, enabling them to take a precise position tied directly to the outcome, accessing institutional scale liquidity, and executing the trade efficiently on a bilateral basis. So, if you were listening, David,
Yes, I
what
was.
what I know this is something that you like to do quite often, and I have a very rudimentary understanding of this, and I could see why they would want to use the events such as the Clarity Act being passed, the U.S. legislation that's being currently moving through, through the Senate and the House. Um, I can see where they would want to use that as a hedge. So, can you explain to and maybe simplify it for us why people use these prediction markets to hedge their positions?
Sure. So they're options. That's what they are. These prediction markets are actually binary option markets. The outcome is either yes or no at expiration. So these are options. They've got Greeks just like options do. They've got a delta.
It's like black or red in roulette.
they've got delta, gamma, theta, vega, and rho too. And there are big market makers providing liquidity on both sides of these markets now. And so these are very valuable instruments for hedging a particular outcome. I'm thinking to myself that, Polymarket, although it's great, Polymarket definitely has some flaws. We saw that recently with a market where it was in May saying, "Hey, will Sailor or MicroStrategy sell, Bitcoin in the month of May?" And the outcome of that market was no, when in reality, yes, Sailor did sell Bitcoin in the month of May. And that's because Polymarket uses a UMA consensus algorithm. Whereas, something like on Hyperliquid, HIP4, that is oracle-less. No oracle there. So those HIP4 markets on Polymarket are going to start to eat some, or not on Polymarket, on Hyperliquid. Yeah, thank you. Yeah, on Hyperliquid, they're going to start to eat some of Polymarket's business. And here's another thing that you need to know: these
it's a superior model.
It is, and they're not created equal. These prediction markets, they're all different. So on Kalshi, so I see, Food is Life was saying, and the house always wins. On Kalshi, when you trade, you're trading against the house. It's like a central limit order book. When you're on Polymarket, you're trading against other traders. And you got to think of this as trading. It's because these are binary options. You're trading an options contract without realizing it. So on Kalshi, you're trading against the house, which is Kalshi. On Polymarket, you're trading against other traders. And on Hyperliquid, you're trading against other traders. So, you just got to understand the differences in these architectures here. So it would be a great and capital efficient way for an institution to hedge a particular outcome by using a prediction market, because it's an options contract. So you can get a ton of leverage for super cheap. So if you want to, let's say that you're long a bunch of Bitcoin, let's say that you got like 10 BTC that you're sitting on, just as an example, and you want to be able to hedge that. Well, what's
Are you looking at my wallet?
I'm just saying, let's say that you're sitting on 10 Bitcoin, you see it dumping today, and you're like, oh man, well, if it goes to 45K, I would really like to not just sit through a drawdown like that. There's a bunch
Mhm.
of ways that you could hedge that. You could use futures, but then you got to think about funding, and that could be very expensive. You could use a money market, but then you got to think to yourself, well, how safe are my funds really on a money market? Because you'd have to put up a bunch of USDC collateral to be able to hedge a Bitcoin position. Um, so that's a ton of smart contract risk. You could go to an options protocol like Derive. Derive's markets are very illiquid, so not really something that's viable. Or you could use Polymarket, or you could use Hyperliquid's HIP4 markets, and you could go on Polymarket and you could say, go to one of the Bitcoin prediction markets, and look at one that goes out for like the next 6 months, and you could say like, okay, it's going to ask you something along these lines, like what's the likelihood that Bitcoin is below 50K by this date, and you would buy that option. You're essentially buying a put. You're basically buying an out of the money put. It's a binary out of the money put. It's a great way for you to hedge your Bitcoin position. Super cheap leverage too. So these prediction markets are very valuable. It's just that people don't understand that they're actually options contracts. Like that's what you're actually trading there. So yeah, we could take a look at Polymarket at some time here, Mike. There's a lot of valuable stuff over there.
Honestly, I know little to nothing about the prediction markets. I mean, I know what they are, and I've read, I know what they do and how they, many of them work, things like that. But I've never actually gone to them. I've never used them. I probably should. Like I said, I get so busy throughout the day, just staying as knowledgeable as possible, on all the stuff that we talk about and building out the business and stuff. I need to get more into these markets and start actually making some money because I mean that's kind of why we're all here.
Yeah, yeah. Well, I mean, today's a good day, man. And so now it's really just a matter of just keeping those emotions under control and sticking to the plan and just being disciplined and adding where appropriate, and yeah, then just let the markets do what they're going to do. So feeling pretty good about the way things are working out so far.
Perfect.
I think,
All
yeah.
right, let's hammer a couple more of these out. We got about 15 minutes. So let's see. We got the Binance listing. Not personally, not a fan of Binance, but news is news. Binance has introduced the Anthropic USDT futures pre-IPO perpetual contract today. What exactly would that be? I know what Anthropic is, but I mean, what exactly, like, what value does that bring to the markets? I guess is the best way.
Well, so Anthropic, I don't know if Anthropic has been confirmed for an IPO this year. I
Mhm.
think there's a lot of speculation that Anthropic is going to go public, this year. Same thing with OpenAI. SpaceX is confirmed for like a couple of weeks, I think. Isn't SpaceX going public in like 2 weeks or something like that? Um, so these big initial public offerings, right now these companies are all private. So if you want exposure to the stock, uh, you can't get it. So the only way to get it is a synthetic, like these futures contracts. So
One arm bandit says the 12th, so in 10 days.
oh, that's SpaceX, right?
Yeah.
Yeah. So the 12th, awesome. That'll be great. Now, here's one thing to think about. How much revenue does SpaceX generate? You know, um, what's
Millions. No. Sir, they were valued at a multi-trillion dollar company. Well, why doesn't anybody keep me up on this?
so it's like it's $2 trillion, I think, is the valuation.
It's trillions.
So two trillion is the valuation. How much money did they make last year? I think it was like $30 billion or something. Like what's the run rate? I think I think that they made like 30 or maybe 40 billion, something like that. We could find out just real quick. Let let me see if I can just, ask good old commie Google. Let's see, how much revenue did SpaceX generate last 12 months? Because you got to ask yourself, like, how did the 2000 run top out? Well, didn't it top out because there were IPOs of a bunch of like valueless web companies? Like the first iteration of the web, there were a
Oh,
bunch of
you're talking about
companies
the
that,
dot com.
yeah, the dot com boom. Weren't there a ton of companies that like went public and, you know, not only
Oh,
did they not
dude.
make any money, but they were just
Yeah.
burning money.
No, no, there was a massive, massive amount. I mean, we've talked about it here on the show quite a bit where, like 90, 95% of all the dot coms basically went belly up and lost, everybody that was, because I mean, venture capitalists, retail, everybody was just throwing money at dot coms and they were all pumping and just almost overnight they like 90, 95% or more of them went away and basically everybody lost pretty much everything that they had invested in those. And
So,
well, that's what we've been talking about with crypto too. There's a
yeah.
lot of vaporware. There's a lot of tokens out there that we keep talking about with no value capture. There's really no value. Even most of them, the company isn't even making any money, any revenue, and the ones that do, there's no connection to the token. So once that realization kicks in, there's a reason why you don't see these institutions, investing in a lot of these projects because they know they're smart. They know there's no value there.
So I'm just, speculating that potentially the SpaceX IPO could mark the top in equity markets for a little while. As that IPO gets digested, and that would, be in line with what happened in 2000. All of those, well, except that in 2000 it led to a crash. The difference between now and 2000 is that the companies in 2000 didn't actually make money. The companies today are cash flow machines. So they can support all of this capex. And I found out that, in the last 12 months, SpaceX generated $20 billion in revenue. Okay. How the hell does that justify a $2 trillion IPO? A company made 20 billion. We're talking about
That's
a 100x multiple. Like,
that's not
what?
accurate at
What the
all.
fuck? So I don't know. It's just like we're talking about extreme nosebleed valuations.
Yeah. Well, and that's the
And
same with a lot of these crypto projects that have tens of billions of dollars in, TVL or market cap, I should say. Um, and they don't even make money. Like a bunch of them don't even generate revenue. And again, the token has no value capture, so there's no connection to it, even if they did. And they have billions and billions of dollars of market cap. It's insane to me.
yeah, and I'm just thinking, like, when I look at stocks up here, um, I mean, look, you don't tend to see markets crash when the companies that are leading the push higher, they call them generals. When you see the generals EPS grow by double digits year on year, markets don't crash when that happens.
Mhm.
But, could we see a pullback? Sure. It's been straight up for 9 or 10 weeks, literally.
Well,
So,
that's actually a great segue into the next topic. So the AI concentration. Financial analysts are highlighting that the S&P 500's 10% gain since late February is heavily skewed. If you remove the AI enabler, stocks in the broader index is essentially flat, suggesting the current bull market is extremely top heavy. So go
yeah.
ahead and continue with that narrative.
Oh yeah. Oh yeah. So here, why don't we? Can you, Mike? Can you share my screen real quick? I want to take a look at some of these items. If we just start with the S&P, this is how many weeks? How many weeks up like this? And hey, this is a historic move. We're talking about 9 weeks straight up. Okay. So this is great for anyone who owns equities. Amazing. You've been doing extremely well. Awesome. And these companies that are driving this move, you know,
Our
Tesla,
pick.
it's really Apple. Apple's been just on a tear. Google was up at 400 recently, pulling back a little bit. They raised $80 billion in an announcement with an at the money share offering today. Nvidia, up here at all-time highs just 2, 3 weeks ago. Microsoft rallying off of the lows. Amazon, pushing higher. Meta not giving up a lot of its gains. And then software is starting to participate now too. Oracle was at 140, now it's at 240. If we take a look at IGV, we're starting to see a little bit of a topping tail on the weekly out of software here. So, a lot of these items have been just leading the market up, these big tech companies here. So when you see earnings growing double digits for these tech companies, you don't tend to see the index roll over and crash. But 9 weeks straight up, and if we just measure the move in percentage terms, we're talking about a 20% re-rating to the upside. So, 20% to the upside, that's a pretty big move over the course of, 3 months, not even, or no, that's like 2 months. 9 weeks, that's 2 months, 60 days, 70 days. What are we talking about? 70 days, 20% out of the S&P? That's an entire year's move in 2 months. So could there be some digestion of this move and maybe some broadening up here as we see, the gains spread out a little bit and breadth maybe starts to improve? Sure. But, volatility has just been smashed. And, whenever I see volatility contract like this, I think, okay, well, when is the next pump in vol going to be? That's what I'm thinking about here. So these names, though, especially Tesla, because the robotics, that's the thing. Robotics. Like when I was taking my walk earlier this morning, Mike, and just walking around, I was just thinking to myself, like, in 2 years, when there are, robots with these brilliant AIs built into them, and they can do tasks for you and they
Yeah.
don't fuck up, like they don't look like, some retard trying to open up the dishwasher, like it actually, like the things work. Uh, like, and they're better than a human in every field, in every discipline. Like that seems like it's going to be a reality, like within the next
Yeah.
year or two, man. So if
Well, and
that
it
is,
just keeps
yeah,
accelerating. AI,
who's
like,
going to lead that charge? It's going to be Tesla, you know?
well, they have
So
the revenue, they have the facilities, they have the resources, they have the engineers. I mean, they have the best of everything. I mean, it's the same thing with SpaceX and rockets. It's just love him or hate him. The only people that I see that hate him is because of his politics, which honestly haven't really changed. He he says the same things. He just started supporting Trump, and all of a sudden he was hated. But he's he just does everything at a higher level.
dude, one arm bandit. Are you trolling in our chat, Mike?
Oh, Joseph started it.
I know.
We invoked, we summoned Joe by talking about XRP earlier, and so I told
Yeah,
him that
yeah.
XRP is my largest holding.
All
And
we got to do is say XRP, XRP,
yeah,
XRP, and he
gotta,
shall
gotta, gotta,
appear.
just gotta say it 3 times in the mirror,
It's like
and
Beetlejuice or something.
yes, Bloody Mary. It's
Yeah.
Joseph materializes.
Oh man. Yeah, dude. But I mean, how do you get exposure to Tesla, in a decentralized way? Well, one easy way to do that, I think, I don't trade on Hyperliquid. I trade on GMX.
They have
But
that tokenized Tesla stock.
I think I might start trading over here on Hype. But if we take a look at HIP3 and then we type in TSLA, they're sunsetting the USDH contract. So you want to take a look at the one with all the open interest. That's USDC. So if we take a look at this Tesla USDC contract, this is a way that you could gain exposure to Tesla. but you got to keep in mind you got funding. Okay, so you've got a funding rate to worry about over here. This is not the same as buying spot. Now, here's one thing I want to point out to everyone watching this. You can hedge your funding rate risk over here on Boros. I don't think that there's a Tesla market, though. There might be. If we go to equities, so I'm looking over here, equities, it just says US, this is for the S&P 500 contract. So you could trade the S&P and hedge your funding rate. That's really great. I didn't know that over here, but there's no Tesla contract yet. So you're not going to be unable to hedge your funding rate risk on the Tesla contract. So basically, if you're long and funding is positive, then you're paying funding. If you're long and funding is negative, then you're earning funding. So it's really simple. Um, but yeah, so I would actually trade this stuff if I could hedge my funding rate risk on those individual equities, because I wouldn't want to pay, I wouldn't want to pay floating. That's the variable funding that you pay or earn when you're trading. I wouldn't want to pay floating. I would want to receive fixed. And so the way that you do that is you use an interest rate swap like over here on Boros. And we can run through that maybe today or something like that during the private coaching session. I'm trying to figure out what I want to talk about today during that private session. I think that it's the one that we do with Ellie or in live. I'm
Yeah,
just thinking.
and so I don't forget, make sure that you send her the link to the to join.
Gotcha. Okay, I'll do that. So I'm just thinking to myself, like, well, what's the best thing for us to go through today? I want it to be, a bunch of different actionable opportunities. You know, so maybe I'm really looking for like delta neutral type stuff.
Yeah.
Something that doesn't have like a directional bias. Um, so I'll come up with some plays over the next couple of hours.
All
But
right.
I see One Arm Bandit talking about getting into a bunch of those plays over on BitTensor Tau,
Yeah, the
those
subnets.
subnets, and that stuff is super interesting. But BitTensor Tau, the Tau token itself, if it gets down below 235 and
It'll go low.
accelerates, yeah, then think about 100 points lower, 140.
Mhm.
So yeah, I would just keep that in mind. I've got like a little bit of some random token. I think it's called Ditto, but yeah, I mean, it's kind of hard for me to get excited about anything unless the subnet like really makes a lot of money. Really, it's really got to make a lot of money. But I'm definitely open to doing deep dive research on any subnet. So if that's subnet 45 or subnet 63 or subnet 112 or whatever it is, doesn't matter. We can run deep dive research on that. Mike, what else is going on in the news?
Let's actually, I think let's go ahead and wrap that up because I want to make sure that you have enough time for the two deep dives and that we still have enough time for the socials. So let's go ahead and move on over to which one do you want to do first? Do you want to do Aster first or BNB or?
Yeah, I'm thinking, um, why don't we take a look at Aster?
All
Let's
right.
let's take a look at Aster first.
And,
And
and let me frame the conversation just real quick. So yesterday we did hype, and for quite some time, both Aster and Hype were pumping, months ago. They were both pumping. Perp dexes were a new thing. They were the hot narrative. They were both on fire. I bought a little bit of Hype. I ended up selling it, once I made some money. But Aster, I personally decided not to touch it, and we're going to kind of get into why here in a minute. Because me and David was looking at it, and that's kind of what we came to. The conclusion that we came to is it's not something that we wanted to touch, and it ended up being a good decision. And again, you'll see why in a minute. But we wanted to do a side by side comparison to show you not all dexes, even though these are both perps dexes, are not created the same. Tokenomics can be different. The mechanics behind the protocol can be different. The architecture can be different. There's many variables. So with that in mind, David, Aster.
So Mike, check it out. I got the formatting of the written reports right. So check it out. I think it's good now. So
Perfect.
here we go. Here's the written report, and I just want to roll through this. Yes, finally, it looks great, dude. This is great. Ah, awesome. And then here's the slide deck, and then this is the Notebook LM slide deck, and then here's that infographic. This is just what I use for the thumbnails. But you can use, Mike, when you make it, I like your thumbnails better actually. And then this one here, this is the source material. So we've got to make sure to include the Gemini deep research source material in here. So
I'll make a note to go through, and I'll do the thumbnails like I've been doing on the other ones. I'll do it on all of them.
yeah, the way that you do the thumbnails is better. I just like also having the infographic. This is just the Notebook LM infographic. This is the Notebook LM slide deck.
Yeah.
This is the Notebook LM. I do the briefing,
Mm.
the briefing report,
Okay.
and then here's the cinematic
The video.
video. Yeah, so this is the cinematic, not the. So let me just show you real quick as before we get started on this. So if we hop in here to Notebook just real quick, when you click on video overview, Mike, there's three of them. You want to click on cinematic. This is the one that you want, not the explainer. Um, so just FYI there. Okay, so let's bring it back on over here. Let's learn a little bit about Aster. I want to start by playing the video content. So I'm actually just going to stop my screen share because it always doesn't work. So I'm going to stop my screen share, and then I'm going to restart the thing so that we can get this working. But hey, that Intel library looks really, really good. It
Yes.
it's all I'm gonna update the written reports for all the rest of them. Or basically, all you got to do is click the button that says AI formatting in the back end, Mike. So when you're going through it, there's a little button there. You just click it. It says AI formatting, and it generates the written report like this. So
Oh, okay,
um,
cool.
yeah, so here we go. Let's play this.
Institutional capital in crypto derivatives faces a structural dilemma. High frequency trading desks require the millisecond execution latency of centralized exchanges, but tightening global compliance frameworks are increasingly pushing large scale capital towards decentralized infrastructure. Following the 2024 settlements with United States authorities, centralized giants operate under intensive Department of Justice monitoring. These strict compliance mandates mean centralized exchanges cannot legally launch highly experimental, high leverage on chain derivatives without triggering immediate regulatory enforcement. To capture this market without risking compliance violations, the world's largest exchange opted for a different strategy. They incubated an entirely separate decentralized entity. This
Okay, so we got to pause here for a second. What the narrator just said, they incubated a decentralized entity. But you got to think about who you're dealing with here. This guy, dealing with this guy.
Yeah.
So, this guy, he, I think that if you want to say that one person or entity is, allegedly responsible for, a lot of pain in crypto, basically for as long as they've existed, it's this guy in Binance.
Oh,
So
October 10th is a big one to point out.
right. So, and there was a lot of speculation that they were basically just, wash trading through their Aster decks, Binance's perps volume. So, yeah, I think that this report is going to paint this in a positive light, and I'm going to make sure that I shit all over him. Okay. So, there we go.
project secured a seed round from YZ Labs, formerly Binance Labs, in November 2024. Binance founder Changpeng Zhao has publicly endorsed it as his preferred perpetuals venue, even disclosing a personal holding of over 2 million of its native tokens. That incubated project is Aster. Initially a multi-chain aggregator, Aster migrated to its own sovereign Layer 1 blockchain.
Yeah. So, Aster used to be called something called Asterisk. And Asterisk was like this protocol on the BNB chain. Remember, these are all BNB chain native. So it was a protocol on the BNB chain where you could lend and borrow and stuff like that. When it first came out, when it first launched.
Designing its API and structural endpoints to precisely mirror Binance's centralized trading engine.
Right, that's important. So if the API's endpoints mirror the centralized trading engine, these things can go back and forth. And so I think that that's probably why there was all that speculation about, the Aster Dex volumes being illegitimate,
Mm.
or fake.
Aster operates as a sophisticated shadow infrastructure layer. It allows professional market makers to deploy their centralized trading algorithms directly onto a decentralized ledger, bypassing direct regulatory crosshairs while maintaining familiar execution mechanics. On standard public ledgers like Ethereum or Arbitrum, executing large derivatives trades creates a structural vulnerability known as the transparency trap. Because order books are public, they broadcast trader intent to the entire network before the transaction is finalized.
You don't want that. You don't want that at all, because then other sophisticated traders can front run your transactions and potentially steal your trades, or generate a bunch of slippage or sandwich you.
This plain text leakage leaves institutional block trades highly exposed. Automated bots read the pending orders and execute front running strategies, sandwich attacks, and coordinated liquidation
Right,
hunts, continuously siphoning value from the original trader.
right.
In early 2026, Aster executed a structural pivot to eliminate this vulnerability. They migrated operations away from public aggregators and launched a sovereign network layer called Aster Chain. This map details Aster Chain's underlying hybrid consensus model. It operates on proof of staked authority, merging the economic alignment of standard staking with a strict permissioned validator reputation system. To process cross-chain deposits and internal state updates rapidly, the network uses a pre-confirmation mechanic. The protocol requires 3 out of 4 validator nodes to sign off on a transaction, bypassing the latency of broader network consensus. This specific node aggregation engine achieves exceptional performance. It processes up to 100,000 transactions per second with a block target time of 50 milliseconds, while entirely eliminating execution gas fees for the end user. These metrics establish direct technological parity with established application-specific competitors like Hyperliquid, which relies on its own custom Tendermint architecture to achieve similar throughput. By controlling the base consensus layer, Aster strips away the inherent sluggishness of multi-chain DeFi. Traders get the millisecond execution speeds of a centralized exchange without ever relinquishing cryptographic custody of their assets. Aster divides its execution pipeline to service different demographics. For institutional desks, it routes trades through Pro Mode, an advanced central limit order book interface. To shield these large institutional flows from public view, Pro Mode integrates an account privacy function secured by zero-knowledge proofs. When a user submits an order, parameters like limit price, volume, and position direction are encrypted off-chain. The system cryptographically verifies the validity of the trade without ever exposing the plaintext data to the on-chain ledger.
See, I really like this because on Hyperliquid, I think everything is public. I'm pretty sure. I
Mm.
really, really like the privacy here. That's very cool. The thing that's running through my mind is I'm learning about Aster for the first time. I've never used Aster. I think I connected my wallet once. I never deposited on there. I've never used it to trade. And as I'm learning about the tech, sounds great. I like the ability to have some privacy. But
The platform seems all right for the most part.
token,
It's the
right?
token that
It's exactly what I was just thinking about.
yeah.
Yeah, that's exactly what I was thinking about. Like, so this protocol sounds pretty cool, but what about the token? If I want to buy the Aster token, aren't there some real problems with the Aster token? I hope that this piece of video content gets into that.
Yeah.
Simultaneously, the network routes the transaction through a single-use stealth address. Using a fresh address for execution breaks the linkability between a trader's primary public wallet and their historical trading behavior, completely masking the origin of the capital. To reconcile this deep execution privacy with regulatory compliance, Aster implemented a viewer pass. This user-generated cryptographic key decrypts a selective historical ledger, allowing compliance officers to audit past trades without exposing active, ongoing positions. This
Okay, that kind of sucks. So, that tells me that, although your trades might be shielded, that I don't think this is like truly a DEX. I think that this is like the illusion of a DEX. But
Mm.
and I don't know this for certain, but it would not surprise me to learn that on Aster, your funds can be frozen, um, by some compliance officer or some AI, or your trades could be closed without your authorization because compliance or whatever. So that's whenever I hear like, oh, well, there's a back door for compliance officers to view your private trades, that makes me think there's probably a back door for them to seize your funds too. So yeah, that's not good.
This cryptographic pipeline provides a major structural advantage. Market makers can execute massive block trades entirely hidden from the public order book, neutralizing MEV extraction and eliminating front-running risk at the base layer. Beyond execution latency and privacy, decentralized derivatives markets suffer from severe capital inefficiency. When traders open leveraged positions, their margin collateral typically sits idle, earning no yield while backing the active trade. Aster addresses this friction point through a trade and earn model, which transforms idle collateral into yield-bearing assets. The
That's exactly what blew up on the Binance centralized exchange on October 10th. Now,
Yep.
whether or not that was intentional or the result of an intentional attack, I think it certainly was. But other people will disagree with me on that. And what I see here on Aster is they're talking about yield-bearing pieces of collateral. Well, that's not necessarily a new or unique thing when it comes to these perp stexes anymore. So
cornerstone of this system is USDF, a native stablecoin pegged one-to-one with Tether. This flowchart maps the capital efficiency mechanics. When a user deposits USDT to mint USDF, the protocol deploys that capital directly into a cold storage vault operated by Cefu, an institutional custody provider. Crucially, these assets remain under Cefu's strict legal custody. Instead of depositing the funds onto an exchange, the vault uses a MirrorX data link to reflect the capital balance inside a dedicated Binance subaccount.
oh, I get it. So that's how they would freeze your shit. So when you deposit USDT, or I'm sure any asset, onto Aster, and it goes into this Cefu vault, and then they just kind of give you like, hey, you've got this amount of collateral to trade with, they could just freeze it in the vault, I bet. I'd be willing to bet that this vault, that any deposit onto the Aster protocol that makes it into this Cefu vault could be frozen.
Keeping the underlying asset insulated from centralized counterparty risk. Aster's automated execution engine then utilizes this mirrored capital balance. It simultaneously opens a spot market purchase and an equivalent perpetual short position for an asset like Bitcoin. Holding equal long and short exposures creates a delta-neutral portfolio. If Bitcoin's price rises, the spot asset gains value, while the short position loses the exact same amount. If the price falls, the inverse occurs. The capital is perfectly insulated from directional market volatility.
Okay, so this could be actually an interesting play. And Mike, I don't even know what the URL is for Aster. Let me see if
I
I can find that real quick. Aster, because what I want to share with everyone, here it is. Aster, got it. So let's check this out. So Aster Dex, it says not available in my region. So I got to turn my VPN on. Mike, mind if I turn my VPN on real quick? Because I want
Oh, go
to
ahead.
take a look and explore this thing. So let me connect over here. Um, let's see here. Let's see. I want to connect to my VPN. I feel like maybe how about Argentina? Hola.
¿Se habla español?
Okay, great. So now I should be able to use this thing. Let's see if this is going to work. Awesome. Okay, perfect. So here's Aster. Now, the thing for me is I want to find out what types of collateral can I deposit on here. Because, if I can deposit, let's say BNB, I can deposit BNB collateral. I could probably find some type of yield-bearing BNB collateral. And then I could head on over to the BNB, perp right here. This one, this futures contract, it's got plenty of volume. I'm going to click through here. And I want to see where is the funding. There's funding. So I don't like how it doesn't, okay, annualized, perfect. So when I was first looking at Aster, it did not show you the annualized rate. It does now. So A long pays a short. So check this out. If I deposit some type of BNB LST or some BNB derivative that pays some type of yield, let's say it's 5%, and then I get short BNB over here on Aster, deposit that BNB collateral onto Aster, get short the perpetual future on Aster. Now I'm earning on my collateral, plus I'm earning this funding rate on my short perpetual futures position. So if I'm earning, let's call it 6 points on my collateral and 14% in funding, then I'm doing 20% delta neutral. But here's where it gets even a little bit more interesting. If you want to hedge away your funding rate risk, you can do that over here on Boros. So if I go to markets, and then do they have a BNB market? And I click on all, no, it looks like there's no BNB market. So that means that those BNB futures, you couldn't hedge the funding rate on those BNB futures. And you couldn't do it on Aster anyway. You can only do it on Binance's main exchange, the centralized exchange. So you wouldn't be able to hedge your funding rate risk, not right now anyway, using Boros or any other protocol. There is no other protocol that allows you to do that. But I just wanted to share with everyone, like the way that I start thinking about this stuff. As soon as I hear, oh, I can deposit yield-bearing collateral, well, that's actually pretty cool. What types of yield-bearing collateral can I deposit? So let's see. I want to see if there's a way that I can, I don't want to connect my wallet to this. I just want to see deposit, what types of collateral can I deposit? Okay, so on the BNB chain, I can deposit USDT, I can deposit, look at that, the APY on ASBNB is 4.5%, so I wasn't that far off. It says ASBNB is a yield-bearing token based on BNB that earns rewards through BNB launch pools, hodler airdrops, and mega drops with estimated returns of up to 17%. Current APY is 4.5 though.
Does the presentation, does it get into tokenomics at all? I want to make sure we get to that.
Let's do that. Let me bring it on back to the Intel. Here we go.
The true purpose of this configuration is yield extraction. In crypto markets, long position holders typically pay a continuous funding fee to short position holders. The mirrored short positions harvest these daily funding payments, which are then distributed backward through the protocol as passive yield for the original USDF mentor.
Yeah, see, this is kind of sort of what I was talking about.
ASTER applies a similar compounding principle to native tokens. Users staking BNB receive a liquid derivative called AsBNB, which automatically farms centralized Binance launch pools and validator rewards. The technical breakthrough is that while these assets generate off-chain yield through automated strategies, users can simultaneously post them as active margin collateral on ASTER to open up to 100x leverage positions. ASTER has effectively engineered a compliant liquidity conduit. It allows decentralized traders to aggressively farm the deep liquidity and funding rates of Binance without ever officially depositing their funds onto a centralized exchange. Operating this complex infrastructure requires an economic engine driven by the ASTER token. In early 2026...
Here we go, Mike. This is, I think this is going to be the tokenomics of ASTER. Let's see what's going on here. And
right.
before we get into this, just real quick, let's just see what has the performance of ASTER been. Oh, not too good. So let's go ahead and watch this part.
This engine was severely compromised by linear token unlocks, releasing roughly 78 million tokens monthly, flooding the market with structural sell pressure. This chart illustrates the protocol's April 2026 response. The development team abruptly terminated the linear unlock model, slashing monthly supply emissions by over 97%. They replaced it with a reward-based staking framework, strictly capping new emissions at 450,000 tokens per week. To complement this massive supply cut, ASTER implemented an aggressive fee reinvestment mechanism. The protocol diverts 80% of all generated trading fees directly into market buybacks of the ASTER token. By mid-2026, this system had...
Okay, let's replay that. Let's replay that part. Because look, I'm in this to make money. As much as I dislike Binance and CZ, if I think there's an opportunity on ASTER or with the Aster token? I'm going to say so. So
Absolutely.
let's see here. I want to replay that part.
Flooding the market with structural sell pressure. This chart illustrates the protocol's April 2026 response. The development team abruptly terminated the linear unlock model, slashing monthly supply emissions by over 97%. They replaced it with a reward-based staking framework, strictly capping new emissions at 450,000 tokens per week. To complement this massive supply cut,
Okay, so 450K tokens per week? Is that
Yes.
per week? Okay, so we're talking about 1.7 million per month. Okay, so
Yeah.
that's similar to what Hyperliquid's unlock is right now, right? Isn't Hype's like around that, something like that?
Mhm.
ASTER implemented an aggressive fee reinvestment mechanism. The protocol diverts 80% of all generated trading fees directly into market buybacks of the ASTER token.
Okay, so 80% of fees go back into the Aster token.
But
So
what
what are those?
what kind of fees has it been generating is the problem, because that's what you pointed out about hype as well, is the programmatic buyback of the mechanics. If the fees drop off dramatically on hype, then basically it can become inflationary.
So
um,
yeah, I mean, look at the fees. So when it launched, there was, fees, but now we're talking about, so 140K a day, something like that, 100 150, 100 and some odd, 100 and some odd K a day. So, what is that, like 3 million a month? Something like that, maybe $4 million a month in fees. So maybe we're talking about like $1 million a week is used to buy back the Aster token. Um, is that enough? Is that enough? I don't know. So I'm just trying to get some general numbers here,
Well, I mean, yeah, it'd be a simple formula. It'd basically be like, fees divided by, how much the price of the token is, at the moment. And that would tell you how many, 80% of that, would be how much they, basically be buying back and, taking out of circulation. So,
I'm just trying to figure out, like, is $4 million a month in fees and only 80% of it goes to buy back the token. Is that enough to put a floor under the price? I don't know. It doesn't sound like it though.
I mean, we
By
could
mid
crunch the numbers
2026,
Yeah, we definitely can. We could model
later.
it too.
Yeah,
Yeah,
yeah.
later.
this system had repurchased over 266 million tokens from secondary exchanges, permanently burning more than $123 million worth of supply, theoretically pushing the asset into deflationary territory. However, analyzing the protocol's fee generation reveals a severe quantitative vulnerability beneath this deflationary success story. The economic design relies on a strict reflexivity loop. Protocol trading volume generates fee revenue, that fee revenue powers the buyback engine, and the buybacks sustain the token price. If volume drops, the entire cycle unwinds.
So this is basically what Hyperliquid does too. Um, it's just that Hyperliquid has a hell of a lot more trading volume.
We can measure the stability of that trading volume by analyzing the volume to open interest ratio. While competitor platforms like Hyperliquid maintain a healthy ratio of 1.57, Aster's ratio registers at an extreme 4.74. In derivatives markets, a ratio this elevated indicates that a massive portion of daily trading volume is not organic directional risk management. Instead, it is driven by automated algorithmic accounts executing wash trades specifically to farm protocol incentives.
Uh-oh, see, that's what people were talking about. This is exactly what people were talking about when Aster first launched, is that everyone was just farming the incentives. And now that the incentives have, basically like
Dried
they're
up.
they've dried up, right? So that's why the volumes have dried up, and that also explains why you had this big spike in fees in the
Yep.
first couple of weeks, and then it just basically went to zero. So not
Yep.
not zero. I mean, 150K a day is not nothing, but it's not the $25 million a day that it was
Yeah.
doing at one point. So
Yeah.
yeah, that's really the look. This is super important to know.
Yeah.
This exposes a highly fragile foundation. If protocol incentive rewards taper off and those wash traders exit, platform volume will crash.
Right.
Without that volume, fee revenue vanishes,
Right.
the deflationary buyback engine stalls out, and the token is left completely exposed to rapid price depreciation.
Right.
Now, and to be fair,
Brilliant.
to be fair, that is true of hype as well, and
Right.
hyperloop. So, I mean, again, we're not trying to paint a positive picture of one and a negative picture of the other. We are just trying to educate you and paint the full picture on each, and that story stands alone on each of those. Again, we're not trying to influence you into buying or not buying anything. We are just trying to make sure that you're fully knowledgeable on the tokenomics, the mechanics, the protocols, the chains, and then with that knowledge, do your own research, of course, and act accordingly. Either do or don't, buy that token. So again, I just want to point that out. We're not trying to, to fudge you out or to, FOMO you into anything.
No. It's just like you got to know what the tokenomics are. You
Yep.
know, so just looking for truth seeking.
Absolutely.
Engineered, yet deeply precarious machine. Its architectural ingenuity is undeniable. The development team successfully built a sovereign, privacy-preserving base layer that seamlessly routes decentralized liquidity into centralized delta-neutral yield strategies. Yet this hybrid approach introduces severe structural vulnerabilities. By routing multi-chain capital off exchange, the entire yield apparatus relies heavily on single points of failure within Cefu's institutional custody and the MirrorX data mapping system. Furthermore, the platform invites intense regulatory scrutiny, offering 24/7 synthetic trading on traditional corporate equities like Tesla and Apple, with up to 1001x leverage, places ASTER squarely in the crosshairs of global securities regulators. But the most immediate threat is internal. As the protocol approaches the tapering of its Stage 6 incentive rewards, the massive volume propping up its buyback engine will face a definitive stress test. ASTER operates as the ultimate high-performance proxy for a heavily restricted centralized giant. Its long-term survival now depends entirely on one.
That was a great description of it. A
Yeah.
proxy for Binance. That's what it is.
Yeah.
It's just a fake DEX proxy for Binance, because the reason why it's a fake DEX is because of that Cefu vault. That's why,
One metric: whether it can convert its mercenary, farming-driven volume into sticky, privacy-dependent institutional flow before the economic reflexivity loop snaps.
no, it can't, because you can't trust that vault. Like,
Yeah.
if you're an
That's
institution,
that's the linchpin right
yeah,
there.
it could blow up in your face, and then you're just stuck holding the bag, a big stinky bag of Aster,
Yeah.
ugh. So, but dude, this report looks great. So the way that it the formatting of all this is awesome.
Yeah,
I'm so happy that.
you'll have to help me clean up the ones that I did.
Oh, it's super simple. All you got to do is in the back end right here.
Yeah, you said hit that
There's
AI.
just this button. It says auto format. Just click
Yeah.
the button, and then for the infographics, just from Notebook LM, add the infographics, and then your thumbnails are way better. The thumbnails go down here at the very bottom.
Yeah.
So yeah, it's just literally a button that I built into the thing. So let's go back to the library. And now that we've learned a little bit about Aster, I want to take a look here at Liquidity V2, because we were talking a little bit yesterday about stablecoins. And, in the news, we saw that there was a USDC smart contract that was frozen, $12 million on some, a layer 2 chain. And, imagine you're one of the investors that has USDC just sitting somewhere, you're earning a couple of points, and all of a sudden one day you find out that, your cash is frozen and there's nothing you can do about it, and you're not getting it back. And all because there was some regulatory risk for Circle, or at least perceived regulatory risk. So you're basically shit out of luck if Circle decides to freeze your assets because you keep them somewhere that some regulatory body doesn't like. You're fucked. you
Well,
know? So,
and a great deep dive to watch is the one we did yesterday, and that's in the Intel library on the website as well. On just stable coins in general, just a basic education on just stable coins. The ones
yeah,
that we're concerned about, that David's talking about, where and we've seen it in recent news where USDC and Tether have frozen Tether USDC and Tether in people's wallets. There's basically what they're rolling out and what they're turning into to be compliant with regulators is CBDCs. So
basically.
it's
Yeah,
so we touched on a couple of potential stable coins out there that are decentralized, that basically you can do your own research, but that's what I'm going to be looking for is I want to make sure that my assets are mine. I don't want the government or any institution to be be able to get their grubby little fingers on my liquidity.
exactly.
Keep your
You
fingers out of
know,
my liquidity.
they shouldn't be able to just freeze your shit, you know? So I'm just thinking, okay, what are the alternatives? Well, you've got Bold, which is what we're going to learn about here now. That's Liquidity's decentralized US dollar product. You've got Curve USD. You've got Frax USD. You've got USDE. That's Athena's product. Um, I think that there might be one or two others, but for the most part, I think it's those four. So what I want to do here is I want to play this piece of content about liquidity, and then also just want to let everyone know that if you want to take a look at and play around with the liquidity, protocol, probably the best way to do that would be over here on DeFi Saver. Just take a look at Liquidity V2 and create a Trove, switch to a smart contract wallet, and then you'll be able to deposit Ethereum and mint the Bold stablecoin. So let's go ahead and let's learn a little bit here about liquidity.
Can't hear it.
Man, this
Yeah, no big deal.
yeah,
Unshare, reshare.
let's do it. Yeah, it's just I wish I knew why it would, cut out the audio. I don't know why it does that. Okay, so let's see here. And I got to add this to the stage. There we go. And let's see.
The original liquidity protocol established a strict governance free standard for decentralized lending by accepting only pure Ether as collateral. Attempting to scale this monolithic structure to accept liquid
It said pure ether. Pure ETH.
Pure.
staking
Only the highest quality of ether.
The highest quality ETH. We don't have any of that ETH.
Yeah, we don't have any of that RS ETH.
Oh my God, yeah.
introduces a severe friction point. Mixing pure Ether with derivative assets
Pure
inside a
ether.
single pool creates a high probability of systemic contagion. Any tracking error or smart contract exploit in a staked derivative like Rocket Pool ETH would inherently compromise the backing of the pure Ether positions. To counter this, Liquidity V2 abandons the static monolithic vault. The system moves to a dynamic equilibrium model driven by multiple isolated collateral types. The protocol isolates the underlying collateral into strictly separated environments while unifying the fragmented system through a single stablecoin called Bold. Decentralizing borrowing across diverse assets requires compartmentalizing the underlying smart contract risk. You cannot safely aggregate yield without first segregating failure. This architecture is managed by the top-level collateral registry, which maps external assets into parallel pathways. Each of these collateral types operates entirely within its own independent smart contract ecosystem to standardize execution. A single branch contains its own dedicated Trove manager, stability pool, and active pool, physically separated from the rest of the network. If a price feed for a derivative asset fails, the damage is completely localized to that specific branch. Liquidations and debt offsets are strictly intra-branch operations. A collapse in a liquid staking token market leaves the pure WETH borrowers unaffected. Because the branches are separate, the protocol applies custom safety buffers calibrated to the specific volatility and liquidity profile of each asset. A critical collateral ratio replaces rigid recovery liquidations with targeted restrictions. If the total collateral of a branch drops below this threshold, the protocol simply blocks new debt creation until the ratio improves. In extreme cases, like prolonged Oracle staleness, a shutdown collateral ratio triggers an automated freeze. This halts interest accrual and opens the branch to urgent, zero-fee redemptions. By siloing failure
Okay, so redemptions. I need to learn about redemptions. Whenever it mentions redemptions in here, we definitely need to take a look at that.
states mathematically, the protocol can list riskier, higher yield assets without threatening the integrity of the broader system. Liquidity v2 replaces the one-time static borrowing fees of the original protocol with continuous user-set interest rates.
Okay, so we got to figure out, how does this work? What is this for? What does it mean? Because when we're over here on DeFi Saver and we're going to use the Liquidity V2 protocol here, we can set the interest rate at which we're going to borrow to mint this bold stablecoin against ETH collateral. But what does it mean to set a low interest rate versus a higher interest rate? What does that mean? Want to find out.
I just posted our stream on to Liquidity and to see if any other people are paying attention. See if they want to pop in the chat.
Liquidity.
Attempting continuous interest across thousands of active smart contract positions creates an extreme gas efficiency roadblock on the Ethereum virtual machine. This formula is the protocol solution for aggregate debt tracking. It converts continuous variables into a trackable index by summing the debt across the branch and weighting it by the annual interest rates. The pending interest across the entire branch is calculated continuously using a time delta. This explicitly bypasses the need to execute loops on-chain. Compounding at the individual level remains discrete. A borrower's specific debt shares are only updated when they initiate a state-changing transaction. Upon interest realization, the minted bold is immediately split. 75% is routed to the stability pool, and 25% is routed to decentralized exchange liquidity incentives. Managing continuous rates introduces gas costs and cognitive overhead for borrowers, requiring the use of interest rate delegation frameworks. Borrowers can assign an individual automated smart contract to manage their position, or they can opt for batch delegation, pooling their debt under a single manager's uniform rate. To prevent rate manipulation by these batch managers, the protocol enforces strict on-chain guardrails, applying upfront fees and elevated collateral buffers. This discrete compounding architecture enables a dynamic, free market interest rate without overwhelming the execution limits of the underlying blockchain. When the stablecoin slips below its peg, arbitrageurs redeem bold for exactly $1 of underlying collateral, contracting the supply to restore balance. Allowing redeemers to choose their collateral introduces a critical vulnerability. They will naturally target the most liquid asset, draining WETH and leaving the system backed entirely by riskier staking derivatives. The unbackedness algorithm acts as the mathematical routing defense against these liquidity drains. This formula dynamically calculates ratios across the separate collateral pools to isolate the highest value. The ratio measures the active bold debt in a specific branch against the safety buffer currently deposited in that branch's stability pool. The top-level collateral registry actively calculates this systemic risk ratio across all parallel branches simultaneously. The algorithm then forcefully redirects incoming redemptions exclusively to the branch with the highest unbackedness score. This strict routing mechanism forces the entire multi-collateral protocol toward a uniform economic equilibrium. Systemic risk is neutralized across the branches before it can compound in a single pool. Once a redemption enters the targeted isolated branch, the smart contract must select which specific borrower's debt to liquidate. Liquidity explicitly ignores individual collateral ratios during this execution phase. This diagram outlines the sorted Trodes queue. Positions are ranked strictly by the user-set interest rate, ordering execution from lowest to highest.
Okay, I get it now. So this is what it means when you set your interest rate. So if you set a really low interest rate and there's a depeg in the bold token that you minted against your collateral in a particular trove, then it could be in the wrapped ETH trove, the wrapped staked ETH trove, or the RETH trove. If you set the really, really low interest rate, then your collateral will be redeemed first.
Yeah.
So if you set a high interest rate,
less yield, less risk.
No, so you pay less and you take more risk. You pay more, you take less risk.
Okay.
So
Okay.
yeah, so if you're over here and let's say that you pop in and you got 10 ETH, right? And you want to mint some bold, right? So maybe you want to take a little bit of risk and you want to go at like a 2x LTV or something like that. So you borrow 10K against your $20,000 of ETH. And if you set your interest rate at the highest level, then you're unlikely to get redeemed when it looks like this bold token has probably had a history of depegging. I'm curious. I just want to see like if that token has had a history of depeg or not. I'm kind of curious just to find out here. So bold, and then where's the majority of the liquidity for this thing? 33 million on Uniswap, 33 million on Curve. Okay, let's take a look at Curve. And I want to just, okay, so yeah, look at that. It has, this is a daily chart. So it has definitely depegged to the upside and the downside. But, it's basically stayed within this type of a range. So between like 9919 and 10088. So, compare this with USDC, and maybe, yeah, so USD and USDC, same thing. But, well, not the same thing, but I'm going to say that they're the same thing. But this is, how wide is this range? That's actually really big. That's actually a big range, plus or minus 1% almost. That's a big range for a stable coin to stay within. So imagine you've got $100,000 of bold, and one day it's worth 99,000, and the next day it's worth 101,000. That's what that means. So, but what does this mean for redemptions, though? So if I mint a bunch of bold against my ETH, and then bold depegs to the upside, does that mean that I get more bold? Or what exactly does that mean? Because depegs happen in either direction, upside or downside.
I would think that you would end up with more bold, and when you redeemed it was more ETH.
I mean, I would think so, but let's see. Maybe it's going to say something about it in here.
Can't hear it again.
Oh no. Okay, so let me go on over here to StreamYard and let's just see what's going on. It says your browser has lost connection to your screen share audio. Try sharing your screen again. Okay, so let me just take note. It's at 5 minutes. Yeah, 5:56.
Okay, yeah.
Okay, so stop screen share. There we go. Stop screen share, and let's try this one more time. Screen share. There it is. Bring this up to the stage.
Targeting the most recent adjustment first. The borrower's self-selected interest rate functions as an ongoing put option. They pay this premium to purchase protection for their collateral against arbitrageurs. This setup triggers a self-correcting macro loop the moment redemptions hit the lowest rate borrowers. Borrowers preemptively raise their rates to move up the protection queue. This causes the aggregate yield to spike, which attracts fresh capital, driving demand and restoring the stablecoin peg.
Okay, so what they're referring to there is important for us to see. So if we hop on over here to DeFi Llama and then we take a look at liquidity bold, this one, liquidity bold, and then we go to the website. The website is liquidity.org. And then we take a look here at the earn tab. This is the, how you can earn yield in that mechanism. I forgot what it's called, but if we just click launch and we, just view this at the Liquidity app, and then we go to earn, you can see the stability pool here. I'm looking for the bold, pool here. So where is it? Multiply, borrow, stake. So maybe it's this one. I don't think it is. I'm looking for um, the bold here. Maybe it's over here. So this is ETH staking pool, bold legacy. Here we go. Bold vault, yield bearing. Nope, that's not what I'm looking for. ETH stability. Here it is. This is it. So see this APY of 1.5%? So what the narrator was just talking about is when you deposit bold into the stability pool here, the ETH stability pool, and then the bold token depegs, there's this incentive, and you can see, we can go back through this one more time. And what it does is it makes the yields in that stability pool go to like hundreds of percent for a short period of time, but that incentive attracts a lot of fresh capital. So that keeps the peg. So this is like a true decentralized stablecoin. It's pretty unique. I don't think that there's anything else like this.
It's, for whatever reason, not the sound isn't working again.
Oh man. Okay. Let me stop sharing and then try this one more time here. And I'm going to add this to the stage, and let's play this again. I'm going to back it up to that part. That's important. So what happens with setting the interest rate and redemptions?
Loop the moment redemptions hit the lowest rate borrowers. Borrowers preemptively raise their rates to move up the protection queue. This causes the aggregate yield to spike, which attracts fresh capital, driving demand and restoring the stablecoin peg. During the DebtOps security audit, a critical vulnerability was identified involving zombie positions dropping below full collateralization. The contract logic skipped under-collateralized positions to prevent immediate loss during the redemption loop. However, this inadvertently caused a global pointer overwrite, permanently trapping bad debt inside the state engine. The constant threat of being redeemed against mathematically compels borrowers to fund their own systemic stabilization, removing the need for administrative oversight. The protocol fundamentally shifts its revenue generation from sporadic, one-time minting fees to continuous, sustainable, real-time interest streams. 75% of this revenue flows directly to the depositors absorbing debt in the stability pool. This functions as a non-dilutive real yield paid directly from actual borrowing costs. This direct yield is mathematically amplified depending on what percentage of the total active supply is currently deposited in the pool. The remaining 25% funds protocol-incentivized liquidity. Voting power for these incentives uses time-weighted linear growth. Scaling power over time prevents capital-rich actors from executing flash loan governance attacks. During weekly epochs, a dual voting mechanism allows downvotes to aggressively disqualify malicious proposals. Liquidity V2 operates as a self-regulating economic organism. Multi-collateral borrowing is scaled and stabilized entirely through architectural isolation and decentralized game theory.
Yeah, but what's that RETH collateral type? RETH.
That's the thing that gives me pause. Is I don't know how I feel about a stablecoin that's backed by ETH with how volatile it is.
Yeah, I mean, I get it. So
I mean, I love everything else about it. I just that's what my brain keeps going back to, is that, if the value is pegged to the value of ETH, it's like, that's a lot of movement.
Yeah, and it's definitely something to be aware of. I'm just trying to.
It's just not just native ETH. There's those synthetics too. So like, what happened? What would have happened if it wasn't RETH? If it was RS ETH? And that shit happened. That happened with Layer 0 and freaking Aave and all that. And all of that got locked. What would have that? Would that have depegged that stable coin and send it to 60 cents or 70 cents or something like that?
I don't know. I need to do more research on Bold, but here's our ETH. So this is the one of the pieces of collateral in one of those
Yeah.
troves. And so, when we were going through in April, that problem with layer 0 and, RS-ETH, this one depegged by 7%. Now it regained its peg, but I'm sure that impacted, borrowers over here on
Absolutely.
liquidity. Yeah. So yeah, that's just
It's
something.
again, it's just something to make sure that you keep in mind and you add it to the picture of whenever you think about using these assets or using these protocols.
Yeah, you got to be aware of this. And so why don't we just take a look through the slide deck here? And before we do, let's check this out. So let me hop on into the back end, and I didn't up for liquidity.
Liquidity.
Where is it? There it is, liquidity. And so if I take a look at this, so if I hit auto format now, is that better? It's still
Yeah.
got stupid warnings.
Well, at least it doesn't have
Auto
like on a
format.
bunch of the ones that I did. At least it doesn't have a bunch of spaces.
Yeah, no, so it's definitely better. I'm going to update this. And so now if we go back over here and I hit refresh, okay, so I've got to tell it to remove these warnings. So I'll do that. I'll do that after our call. But I just want to take a look down through this real quick. So I'm looking for anything to do with redemption, anything to do with, redemption routing. Systemic risk is managed by routing bold redemptions to collateral branches based on their unbackedness, ensuring uniform protocol security. So what is unbackedness? What is that again? So collateral branches, right? Okay, just scrolling down through this, minimum collateral ratio is 110%. So it allows borrowing of you've got big LTVs over here, so you could borrow up to 90%, against your ETH collateral. That's pretty cool. I don't think that you can do that on many other protocols. Not this much. I mean, maybe 83 or 87%. Actually, I think it's on some you can do like 90 or 93% borrowing against ETH. Critical collateral ratio. Okay, recovery mode, shutdown collateral ratio. I'm looking for information to do with redemptions. Okay, so peg stabilization. It says redemptions serve as the core mechanism for maintaining the bold $1 peg. So when bold trades below the peg, arbitrageurs redeem it for $1 worth of underlying collateral. So if bold depegs to the downside, you can redeem your bold, which I think burns it, and you'll get $1 of the underlying collateral, either ETH, wrap staked ETH, or RETH. Okay.
That makes
So
sense.
yeah, so it says to prevent the depletion of the most liquid assets, that collateral registry routes redemptions based on unbackedness.
You want to share the other screen?
Oh crap! I wasn't even sharing that the whole time.
No.
Oh man, yeah. So we're just going through and we're learning about redemptions. So redemptions for this liquidity stablecoin,
So
which is
if people are having a problem seeing this is on our website, the node.pro. Go to the Intel library, and you can pull all this up at your leisure. It doesn't cost anything. It's all you have to do is go in there, and you can read through the material. You can watch these videos that we're playing here on the show. You can go through the slide decks. Again, we're here to educate you. So
yeah, and this stuff is all at no cost. So check this out, the interest rate queue. So that was this over here. So when I say create trove and this interest rate, so how you see how I can set this thing here? So if I go in with 10 ETH and I want to borrow the maximum amount, just about, so I can set my interest rate, and if I set it really high, I mean, I don't know that you would really want to do that. 7%, paying 50%, you're unlikely to get redeemed against if the stablecoin depegs. But if you put up ETH collateral and borrow this much against it, that's a very, very aggressive borrow. So maybe you borrow at like a safer LTV, and then if you set your interest rate, super high, maybe you want to borrow like at the top up here, well, then all of a sudden you're paying quite a bit, but you're unlikely to get redeemed against, or at least it seems like less likely to get redeemed against. Take a look at the liquidation price, $1,100. That's about a 40%, 45% drawdown. So that makes sense. Let's bring it back on over here to the written report. So interest rate queues. So within a branch, and those branches, there's 3 of them. There's wrapped ETH, wrap staked ETH, and RETH. So within a branch, those redemptions are ordered strictly by the user's set interest rate from lowest to highest. So a Trove's collateral ratio is ignored. So you got temporal priority. It says it ties in interest rates are resolved via last in, first out ordering. Okay, got it. So if you set your interest rate higher than someone else before someone else resets their interest rate, that person who changed their interest rate after you will get redeemed before you. So game theory, it says it's a put option. Borrowers pay interest as a premium to shield their collateral. If redemption risk spikes, borrowers are incentivized to raise their rates to move up the protection queue. This increases the yield for bold stakers, boosting demand and restoring the peg. Okay, so this is an interesting mechanism. So I'm starting to understand how this thing works. So we could make a comparison to a money market. Let's say we make a comparison to a money market like, maybe like Aave, just because everyone's familiar with Aave. So if we head on over to Aave just real quick, and let's start using if we're going to talk about Aave, let's start taking a look at the Aave v4 protocol. So if you're over here on Aave and you deposit, ETH collateral, okay, let's just say, as an example, you come on over here and you deposit ETH collateral on mainnet. Okay, I got it. Thank you. So you come on over here, you deposit some ETH collateral, and then you decide you want to borrow against it. So how much can you borrow against it? Well, it looks like use as collateral. You can borrow these. Yeah, Mike, you there?
We're about to run out of time, but I definitely want to get.
Oh yeah, run through the socials. Yeah. So
yeah.
But we'll finish up later.
All right, sorry about that. All right, so let's share this tab. All righty. So if you want to make sure that you don't miss any of our shows, again, this show is Monday through Friday at 9 a.m. Pacific time. And you can find us on YouTube where you can join the conversation, join the chat. Tell us we're full of shit. If we're going through these deep dives and you know about that project and you know for a fact and you can cite your sources and show us where we're wrong, please, we welcome that here. We are not one of those channels that are going to call you stupid or say that just tell you that you're fudding us out or that you're a maximalist or we are here to just put out the facts. No bias. So if you want to, come on over. It is at the Node Network, all one word. And you can find all of our channels. We are truly a network. So you can find this show, The Node, Monday through Friday at 9 a.m. It's our 2-hour morning show. Crypto and Chill tonight, Tuesdays and Fridays at 5 p.m. Me and Jeff usually just, kind of have a beer and shoot the shit and just talk about what's happened in crypto in the past couple of days since the last Crypto and Chill show. The Blockchain Report. Jeff has been doing airdrops for years now and is really, really good at finding these early projects. So if you're into airdrop farming, it's not as lucrative as it used to be, but you can use that skill set like he does to find these early projects that potentially have a lot of upside, that potentially have a lot of upside. And he is going to be adding these to the library on the Node.pro. So if you're looking for, maybe we'll do like a section in there for small cap, early projects or something like that. That actually might not be a bad idea. And then sovereign soil. This is where I share my experience. I was in the military for over 20 years, been doing emergency preparedness for over 20 years. And since I retired over 10 years ago, I have been a homesteader. I sold everything, moved up into the woods, bought a big piece of property, built my own cabin, and homestead. So this is where I share my experience with that. And at times I do interviews. The last show that we did, a very old friend of mine that, and I stress old because we're both old, but we've been friends for over 20 years. I was on the ski patrol with him in Utah at a ski resort there. And he has a shooting system that we went over that helps people transition from iron sights on the pistol to a red dot sight, so that they can make that transition faster. So great content there. I've gone over firearm selection for for homesteaders. We've talked about emergency prep, doing your bug out plan, all that kind of stuff. And I even shared, my experience, building my cabin, because I literally did it myself. Lived in a tent, from the ground up, built the whole thing myself. So I shared that whole experience with the pictures and stuff that I took during that time. David, Monday through Friday at 1 p.m. Pacific, 4 p.m. Eastern, at market close. David does about 15 to 20 minutes of technical analysis, charts and analysis on all the different commodity stocks, crypto. And on Tuesdays and Thursdays has been doing a live coaching session with Ellie from our community. So make sure that you tune into that later on today. Jeff is also a DJ in the San Francisco Bay Area and knows a bunch of other DJs, and so has been doing interviews with all of those DJs, and a bunch of them have been doing a guest sets to where they spin their music and do tutorials. So if you're into that style of music, great to catch on Saturdays at 6 p.m. Pacific. The Red Pill is a show that we do here. It is based off of an old show that I did called Bullshit and Bourbon, but we call it the Red Pill now. And it's where us, the three of us, me, Jeff, David, and occasionally we have guests, and we just talk about hot button issues. If that's legalization of certain drugs, ancient civilizations, people's personal experience with mushrooms and other psychedelics for therapeutic reasons, religion, whatever. This is just where we show that you can have very heated discussions about these types of topics and still be friends. Because often we disagree on certain things, but it's okay. You can be an adult and you can have an adult conversation and respect each other's point of view and not agree. So that's kind of what that's all about. And then gaming and chill. This is our channel where us and people from the community jump on and just play different video games and just kind of hang out and laugh and joke. So nothing too serious. And then the Node, music, 24/7 music. This is David has been generating custom AI music that that you can listen to in the background. So ambient techno. It's just good background music when you're working, when you're cleaning house, whatever. So a little something for everybody here. If you want to follow us on X, then you can come on over here and find us at the Node_network and follow us. This is where I share and post, just interesting news on crypto and things that I find throughout the day. And then last but definitely not least is our official website, the Node.pro. And this is where you can find all of our no-cost educational content. So the very structured, very well put together DeFi University, the Intel library that we keep talking about, of all these different deep dives that we do. You can find them all here, and and go through at your leisure, again, at no cost. I cannot stress that enough. Many, and pretty much everybody out there would charge you for things like this. We want you to be educated. We want to make sure that if you invest in these markets, that you do it fully knowledgeable, because that is the struggle that many of us, myself included and David included, when we got into these markets, is we had to pay market tuition. We had to make a bunch of mistakes because everybody wanted you to pay to learn. And so we decided when we started this channel, me, Jeff, and David, that we wanted to give pretty much all the entry level stuff away at no cost. The advanced stuff, like the coaching calls and things like that, when you're wanting to go to the next level, we do charge for that stuff. But again, it's if you're wanting to get into these markets, you don't have to pay to do it. So I can't stress that enough. We got our newsletter. I'm going to gloss over this a little bit just for the sake of time, but this is our AI generated newsletter where you pick the assets, the commodities, the stocks, the S&P 500, crypto, whatever it is. You can generate a newsletter that is specific to your portfolio. It's not assets that we choose. You choose the assets, and it will give you the news. It will give you the liquidity flows. It will give you the price. It will give you trading ranges. It will give you liquidity pool ranges. It gives you a ton of information, and in a matter of like 10 to 15 seconds. Something that when I was doing the newsletter manually would take me an hour and a half to put together. This does it in a matter of seconds. So cannot stress this value enough. Go ahead, check it out. Again, at no cost, do the preview. Or if you want it delivered to your email, it's $20 a month, 66 cents a day. I know my time is worth more than 66 cents an hour. Community. If you want to join the Discord, you can join it here. Again, no cost. We do have a premium channel in there. That is for the live calls. That is for the Monday, Wednesday, and Friday live calls with David and the advanced community, where we do advanced lessons on doing interest rate arbitrage, on doing looping strategies, things like that. And people in the community, it's a live video call, open forum. People in the community, they also share successes and failures that they have had in different strategies that they've tried. So it's a great place for community and mentorship. Find somebody that you vibe with, and that maybe you can communicate with, and they can help take you to the next level. It's not just myself, David, or Jeff that might take you to the next level. That is the power of a community. So again, no cost community and a paid advanced community. The store. If you want to come in here and help support the channel, not necessary, but we greatly appreciate it. You can buy T-shirts, hats, hoodies for all your favorite shows here on the Node Network. Hats, beanies, all of it. By all means, we appreciate any support you can give. And then the programming. If you want to come in here, it has the calendar on each day. The different live shows that we have, the live calls that we have, and the coaching that David is showing on Tuesdays and Thursdays with Ellie. You can come in here and you can actually schedule a no-cost consultation. And he can sit down with you and you can figure out where you're at in your journey, your risk tolerance, your portfolio, and decide if it's something that you're going to get value out of. If not, he might point you towards DeFi University or something else to get you up to speed, to make sure that you extract the max value out of this coaching program if you decide to pull the trigger on it. And that's about it. And I do want to point out, above all, we appreciate all of you that tune in. And please, 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 it costs you nothing. It's a movement of the mouse and a click of the finger. If you can just like, follow, subscribe, share, if you find value here, we greatly appreciate it. It is what does the most to help us grow and get this information and all of this no-cost educational content out to as many people as possible, so that they do not end up being the exit liquidity for other people and end up getting shilled a project or a token and getting taken advantage of, because we've all been there, and I want to help people to not have that happen with it. So with that, thank you all. David, thank you so much. And until next time, Veteran Crypto out.
Peace.